Well, good afternoon. Hey, everybody. This is a panel discussion on what's new in DeFi and Celo. So, going to be an educational session talking about the current state of things, where we're headed, lots of learning, and also about the future of Celo and DeFi, that is. So we have a very rich panel today. We'll go around and do a quick round of intros so you can learn more about the panelists, what they're doing, and meet with them afterwards if you have like any specific interests. My name is Jason. I'll be leading the panel discussion for today. I do a lot of the founder programs at the Celo Foundation, so I lead founder programs, working closely with founders that are building across different domains and helping them build and ship product on Celo. Without further ado, I want to hand out to Andy, who can go ahead and introduce himself, and then we'll switch over to a couple of housekeeping announcements. So go for it.
Great. I'm Andy Singleton, and we're working on a Celo savings, which will bring 10% dollar yield to Celo. It's a farming boosted product based on Terra's Anchor as an idea. And you might wonder where the 10% comes from when the underlying yields are around 5%. And the answer is that we're essentially solving three different problems at once. One is to suck assets into Celo, which will inflate the whole ecosystem. A second is to provide a stable yield product which people can sweep into from all of their payment wallets. There's a lot of demand for that. People have been coming up to me. And the third is to actually boost the value of Celo, to apply some farming rewards to get people to hold Celo as the collateral for these dollar deposits and get your Celos up to $6 or $7.
Sweet. That's awesome. Denali, do you want to take us away?
Yeah, I'm Denali. I am the lead blockchain engineer at Kresko. And Kresko enables crypto-backed synthetic assets in a capital-efficient manner. And Kresko's mission is to bring these assets to the developing countries and grow the wealth of people there. These are assets like indices, commodities, and stocks, such as Apple, gold, or the S&P 500. That's our vision.
Sweet.
Yes, so I'm Rudy, the founder of Nested. Nested is a decentralized social trading platform. So on Nested, you can create and replicate portfolios. Those portfolios will be tokenized in the form of an NFT. You can browse, of course, directly from our dApps any portfolios. There are many filters available to make sure you find what you are looking for. And when it comes to the perks, each time someone replicates your portfolio, you earn royalties, and those royalties are a part of the platform fees. So today, you can only create and replicate spot strategies, but in the near future, your nested NFT, your portfolio on Nested, will become a vault generating two types of incomes. The first one from the royalties, at each time someone replicates you, and the second type from the third parties you are staking, lending, yield farming your assets on. And of course, each time someone replicates your portfolio, if you are staking, lending, yield farming your assets, you will also earn a part of their interest. So this is Nested. We just raised 7.5 million from the best angel and institutional investors, including Alan Howard. And we are also part of the DeFi for the People initiative.
That's awesome. Thank you so much. Henry.
Yes, my name is Henry. I'm currently doing a project called Double. We have been stealth for a long time, or not long time, has been stealth by purpose. And because of this Celo partnership, we sort of make it introduced to the public last week. Basically, what Double really does is solve the AMM liquidity providers pain point. We are not AMM. We are going to support like all the previous panels that AMMs, the issues they're having. Basically, what the pain point for the liquidity provider today all comes because of 50-50 pool design, where the project has a lot of tokens, but they don't have the capital side to create the liquidity for themselves. On the other side, the capitals, which is want to earn AMM fees, they have a lot of capitals, but they don't have the token. So naturally, the question is these two sides can collaborate? If they collaborate, they could achieve their goal jointly easier. If they don't, it's harder for them to achieve their goal separately. It's not very obvious to a lot of people outside the market. I designed this one for me as a founder of the project. Basically, Double is a protocol that enables collaboration between the token side and the capital side, where the capital only will capture all the trading fee, which is effectively Double the return on invested capital. The project token side doesn't capture the fee, but they get their liquidity boosted without supplying the capital side, which they actually don't have. That's the liquidity challenge for them. Yeah.
Fantastic. So a lot of your protocols involve incentivizing a lot of early users and getting them onto the platform. And in DeFi, I mean, it's very easy to build, and the barrier to exit, which is an underrated idea, is very low, meaning that incentive can sometimes retain people, and people can keep like forking and moving out of the protocol very easily. And sometimes, protocols resort to supernormal yields and like high APYs to actually retain users. So in the future of DeFi, how do you envision retention of like users to a protocol, and like how do you create that protocol stickiness as you're building out these like businesses for future of DeFi on Celo? Go ahead.
Okay, great. So I do think that users should be there for the product and not for the token. So of course, the token is a part of the product. It must be there to straighten your offer and fidelize your users, of course. But they first have to be there for the product. You have to market fit. It's a necessity. Your users don't have to use your application because thanks to your tokens or the token incentives. And also, of course, your product should be network agnostic, market agnostic, trend agnostic, sorry. So yes, if the market goes up, you have to get users, and if the market goes down, you also have to get users. And this is why AV is so like powerful. And if you want to keep your users, the UX should be one of your main advantage. I mean, today DeFi suffers from overcomplication, and you must be obsessed with it. You must build thanks to your according to your user feedback. It's very important, and so you really need to be focused on the UX, and it's something quite missing there. And at Nested, even I'm testing all the features with my mother to be sure that it's understandable. And last thing, if you want to onboard the masses, so at Celo there we are here to onboard 6 billion people, and if you want to onboard the masses, you need first a mobile app, because retail investors want to trade on mobile and everywhere. Second, you need to offer on-ramp and off-ramp solution, because retail investors want to invest 10K USD and enjoy from bigger returns. The interaction with their bank account should be as seamless as possible. And last thing, you need to find wallet, a self-custodian wallet with a Web2 user journey, and it's traditional authentication process, a login and a password, because no one wants to deal with the 24-word seed phrase of, of MetaMask. So that's all. That's my point of view.
That's awesome. Doubling down on the keynote earlier about like user experience, I think I strongly resonate with a lot of what you're saying. Denali, do you have perspective on, and you're building like synthetic assets on Celo with Kresko, any perspective on how you're building for retaining the next billion users as they onboard to Celo? This is one of the unique protocols that we have there, and so any thoughts on how you're building for retention in the long run?
Yeah, I couldn't agree more with you. I think that short-term community incentives with tokens obviously is quite sticky for those very early users. They're really there for the yield. Long-term, I think they will stay for the product, right? If we look at traditional Web2 companies like Facebook or Instagram, people don't use them because they get paid tokens to use them. They use them because the product is incredible. You have network effects, all the money's kind of flowing back into perfecting that. They don't need the token incentives to make it sticky, right? I think because most of our companies at this point don't have that kind of treasury and bankroll, we need to use these early incentives to kind of get that kickstart. Long term though, you can't have token incentives and just inflate away your total supply. It simply inflation has to go down over time in the real world and on your protocol. But I think the solution truly is product and being product centric. Like you were saying, mobile has to be there. I think you need an incredible user journey. So that's not just going through the blockchain actions of swapping, different things. Actually, if my mom goes and hops on, she understands to click a button, and it is literally one button. It'll run all the transactions for you. It needs to be so simple. You don't even have to think about it, because that's why we all use Instagram, Twitter, everything like that. That's why it's really, really sticky.
It's awesome. Thank you so much. Eddie, do you, as you're building out for scale, and based on your experience, you've had a lot of experience dealing with like institutional capital, and so thinking more at scale in the future of Celo, future of DeFi. What do you think are the biggest obstacles that you're seeing to get like institutional capital onto DeFi, and how best might we bridge that with by building on DeFi right now?
I'd like to go back to your earlier point, which is that institutional capital is hot money, and it's going to go away, right?
Yeah.
I think that the farming rewards are going to go away over the next 2 years, and I actually think Celo is a fantastic platform to prepare for that, because what Celo is building, what I see everyone here working on, is a consumer-focused mobile banking experience. Those consumers are not hot money. If we can establish credibility with them, a savings account doesn't have to pay 10%. 5% is great. We've established credibility. We've given them safety. We've given them the 300% collateralization they're going to get from CUSD. So actually, the institutional, there's a lot of institutional money in the system right now, and that's the hot money that we're all talking about trying to avoid by creating a better user experience. Celo, thank you for giving us that channel, that mobile channel. There are a lot of barriers to sort of the big banks coming in that are largely regulatory. They've walled themselves off behind regulation and cost. And I used to think that we were going to bring those guys over. But now I can see that the systems are just not compatible, because there's a fundamental difference between how a bank operates in the fiat world, where you can't see where your money is, so you have a lot of regulators and auditors and administrators to protect you and watch that money. And all of that stuff just gets vaporized in DeFi, and it gets replaced by real-time visibility into where your money is. And that's a very difficult bridge to cross. I wondered why they weren't coming. But if you think about how different those approaches are and how little room there is, really, for the existing banks, sure, their money will come over, but the organizations probably will not.
Absolutely. Thanks for that perspective. Yeah, go for it.
So I'm going to comment on both questions here. First of all, I actually have a different perspective of the sustainability. People hate using token, but I have a different view. The reason I got into crypto is because of tokenomics. You had to think about what's the only difference between Web3 and Web2 is token. If you don't have a token built in your product into your go-to-market, you become a Web2 product. You have no way of competing or winning any of this Web2 giant. However, if you have Web3, you have a shot to disrupt all the incumbents like Google, Facebook, Amazon. The question I think the whole community did wrong is they don't know how to design token, use a tool to successfully sustainable long-term. So example with the AMM, the yield farming thing. The token should never be used to incentivize liquidity, because from token economic design perspective, the token inflation should only be used if somebody contributes value to your economy. If the economy value is larger than the token you used, you have a positive return. The key challenge is very, very hard to design that. And because tokenomic design is very challenging field, there are kind of like two hands people who can really grasp that. Compound started kind of yield farming trend, and compound design actually pretty good. Others are copied wrong. I wrote an article about compound token distribution before compound token was even released. I kind of predict the whole DeFi summer, the mania thing happened. The reason we did a double, because I don't believe the AMM liquid yield farming should be there, and as a project founder, I should never want to use it. That's why I figured out a way is without token inflation, can I still incentivize the capital to create liquidity for any token project, which is double by design. We figured that out. And I'm happy to announce that we're going to launch it on Celo, because Celo commit from a foundation perspective. They have a Celo Gold, Celo Dollars, they're going to pair with any token issued or bridged to Celo, then basically create liquidity for all the tokens. So basically, you're going to enable the other tokens to be successful, and Celo would compound, any holders of Celo tokens will compound their interest because the capital side captured all the trading fees. And because of activities, we're going to enable all the AMMs to become active. You have more trading volume that way. So counting on the institution money, actually, I think institution money is not even coming yet. Based on my conversation with all the institutions coming, they have $billions of trillion dollar seed outside DeFi today. They are willing to come in. More capital can be deployed today on DeFi today. They want to come here to earn more return, which is under 0% in the bank. The key challenge, there are two. One is regulation. Technically, they could work around by giving the money to hedge fund, which is a gray area where you don't need the KYC or the counterparties. The second is actually the APY is not a good APY. If you consider risk into this APY, the risk-adjusted APY is negative. Those traditional banks, they are very sophisticated. They do the math. They say, OK, I'm not going to take the risk. I'm not going to deploy capital. And the key challenge, how to solve the attract is reduce the risk, which is double significant reducing perm loss risk. Make a lot of pools become adjusted APY, positive APY. That's a bit better than zero. That way, you're going to attract a lot of capital coming in. That's going to really kind of take the DeFi OEM to next level. So just my information, but in talking to all the kind of traditional capital side.
Yeah, absolutely. And really excited to have double deploy on Celo. So shifting gears a little, I think DeFi is heavily centered around the community that you build, and you've been experienced dealing with building like community at the earliest days, and with those lofty missions that you have, your community is what sticks with you. And so there's a lot of DeFi builders in the audience as well. So any tips or any methods that you've had in building that earliest lot of community of users that have been dedicated to your protocol? Just open question to anyone in the panel.
Yeah, sure. I think there's a lot of different ways to go about building community, and I think the most important thing is to start with what you know. So I'm an engineer, and my background isn't necessarily in community building, but I had a lot of success early on finding that niche community for different projects I was working with by actually going to hackathons and a lot of blockchain-oriented meetups where I was talking with, I guess, people in my niche, kind of like-minded developers, who then started using the platform that I was working with or then building applications on top. So that would be a perspective that I might take. I think that might look very different if you're coming from a different cohort of users. I guess to put it shortly would be start with what you know, because that's what you know best.
Awesome. Anyone else? Thoughts?
Yes, I will just give one tip. The most important thing isn't the number of followers you have on Twitter. It's about the number of users you have. You can have 30,000 followers on Twitter, but only one user. The thing is that at an early stage, as a founder, you must be very close with your community, talk with them on Discord, Telegram, etc. It's very important. It's something that you should do at least 1 hour per day just to receive the feedback, get the feedbacks, and iterate on them.
That's great feedback. We've had a lot of DeFi protocols come in, and with very early incentive, and a lot of foundations do have incentive programs. In fact, the Celo Foundation has also launched previously the DeFi for the People Nested Finance has been a part of that. And so these incentives often attract folks that may not necessarily stick around in the long term, and and may not necessarily grow the share of the pie. In some sense, it's being recycled. And so I'm curious to hear your perspective on how we could better improve that retention loop when building in DeFi to essentially have more people stick around. And yeah, any thoughts there?
Obviously, with all the bridging that's coming in, people are going to be moving between blockchains. So this idea that your blockchain is an isolated city that people build in and then never leave is not going to be true. And there's going to have to be a lot more specialization among what blockchains do. I think Celo has chosen a path, which is consumer-facing mobile banking, and that's there's a lot of user experience that goes with that and so on, and a lot of back end to generate the kind of yield stability that those people want. But specialization, that's one way to make sure that you retain your customers.
I like that.
Not just X for blockchain Y, right?
Yeah.
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 Maybe I can comment on here. I think fundamentally is for your product to succeed in the long term, right, not short term, you need to actually provide some fundamental value to a certain type of at least segment of customers, right? And if you don't have that, your product probably just short term should not be exist for the long term. So basically, you need to figure that out, and they figure out what the best way to get to them. So the initial early yield farming, whatever incentive structure is actually not a bad idea. But you have to consider this way is if you create an incentive to get a bunch of people, even the people mercenary, they come around, you generate the marketing buzz, which you consider this cost as a marketing cost because even user acquisition, what the Facebook did, they spend a lot of money on doing user acquisition. If you treat those things like because they come in, they talk about Celo, then somehow those message comes propagate to the right target customers, the Celo is, or the DeFi is targeting. So you retain those one, but you're not trying to retain the mercenary capital that way. I definitely think Celo has kind of mission trying to target certain the way, but I always think like the challenge how to grow the user base quickly enough for to become to attract create a kind of network effect that way. But fundamentally, I think early on use some kind of incentive is not a bad thing. Remember, this is Web3. The weapon you have, the tool you have, which Web2 does not have, is the token. The question is how to use them properly to achieve the goal that you want to achieve.
Very interesting perspective there.
Yeah.
Andy, you wanted to?
Well, I'm just going to, I think sorry, what's your name?
Henry.
Henry, I think what Henry said is true. You have to grow and create that network effect. And that's why these incentives are out there. And I've recently had sort of an epiphany on this. So, and it has to do with, I'm a student of Anchor and Terra and their economics, which are actually terrible. They sell you $1 for 100% profit, and that dollar could go to zero at any time. But in a growth environment, it's actually great to have what I call negative capital. So most banks and businesses, when they bring in $1 of, say, deposits, if you're a bank, you have to have another 10 cents worth of capital. So it's difficult to grow. In a growth environment, to have a negative capital, for instance, 100% negative capital, you get $1 back every time you bring in $1 if you're Terra, right? Or 15 cents if you're Frax. You can adjust it, right? You can use that tool, and just adjusting that tool so you know when am I growing and when am I going to, $1 for $1 and not using that negative capital. It's a sort of an abstract thought, but it's a way of analyzing, of using both those tools, the sort of the Ponzi accelerator and the real returns with real capital. But the negative capital does have a place.
Interesting thought on the negative capital there. Shifting gears, thinking about more on the state of DeFi on Celo and like looking forward, what are the key building blocks that you see that would enable like the future of Celo? And maybe Denali, you could take that, and Rudy after. Yeah.
Yeah, so I think a lot of the existing protocols that are available are very composable, and we intend to integrate with them. So when we launch, we're not going to have our own AMM, where the synthetic assets will trade, rather partner with existing AMMs on Celo. And it's a great way to onboard users and also really create that give back to the community. I think composability is, for me, one of the most important things. When I develop a protocol, I'm always trying to make sure other people can build on top of it or build underneath it. They can build wherever they want and they can plug in. So I think those building blocks on the application layer definitely exist on Celo, and it's just about wiring them up and then really getting the UI seamless and creating a nice experience.
Yeah, fantastic.
Yeah, so about myself, I think that there is a lack of liquidity on Celo right now, on chain, I mean, and I do think that the DeFi for the people initiative makes sense there because you must bring the liquidity. There is a lot of competition between L1s, and I do think that if you want to build elaborate products, you need first you need to find liquidity, and this is one thing missing on Celo, and this is really what why the DeFi for the people initiative makes sense. And I guess that's all. That's the only thing missing. Otherwise, about the technology, I mean, it's one of the best. It's one of the seamless experience that you can meet in this decentralized world. So yeah.
I like that. User experience and liquidity. That's excellent. So we have about a minute on the timer there to. So opening it up to the audience. Does anyone have questions for our panelists? Quick questions on DeFi, on Celo, anything that you're building you want to ask our panelists today? Well, fantastic. Okay, excellent. Thank you so much for taking the time to join us on today's panel, or a manel, as I'd like to joke about. Hopefully, this is not representative of the diversity in DeFi, but I would love to keep the conversation going, and thank you so much for taking the time to come here, and do connect with the speakers offline, and thank you so much.
Thanks.
Thank you.